Right now, while you're watching this video, something is happening to your mortgage that the banks are praying you never figure out. A silent mechanism has been activated that is slowly converting what was supposed to be your path to financial freedom into a sophisticated trap designed to extract maximum wealth from your family for decades to come. This isn't conspiracy theory. This isn't fear mongering. This is mathematics. And by the end of this video, you're going to understand exactly how the trap works, whether you're already caught in it, and the specific steps you can take to escape before the walls close in completely. But first, I need 60 seconds of your time for something important. This channel exists to tell you the truth that banks spend millions making sure you never hear. But here's my problem. I'm being crushed. The algorithm buries content like this because it doesn't serve the interests of the financial institutions that spend billions on advertising. The only way I can keep making these videos is if you subscribe right now, not later, not after the video, right now. Hit that subscribe button and tap the bell, because if this channel disappears, so does one of the few voices willing to tell you what's really happening to Australian mortgage holders. Please, I need your help to keep fighting. Now let me show you the trap that's closing around millions of Australian families. Every month you make your mortgage payment and you feel like you're making progress. You check your banking app and you see the balance has gone down slightly. You think to yourself that you're paying off your home, building equity, and moving toward that magical day when you own your property outright. This is the illusion. And for a growing number of Australians, it's a dangerous one. Let me show you what's actually happening inside your mortgage right now. When interest rates were at 2.5%, a $600,000 mortgage with a 30-year term had monthly repayments of approximately $2,370. Of that payment, roughly $1,250 went to interest and $1,120 went to principal reduction. You were actually paying off your loan faster than the interest was accumulating. Today, with rates at 6.5%, that same $600,000 mortgage has monthly repayments of approximately $3,790. But here's what most people don't realize. Of that $3,790, approximately $3,250 is going straight to interest. Only $540 is reducing your principal. Read those numbers again. You're paying $1,420 more per month than you were 2 years ago, but you're paying off your actual loan $580 less per month. You're working harder, paying more, and going backwards in real terms. And this is the first layer of the trap. The mathematics of high interest rates mean that even though you're making larger payments than ever before, you're making less progress than ever before. The banks are extracting more wealth from you while you build equity slower than at any point in modern Australian history. Now let me show you the second layer of the trap that almost nobody understands. When you took out your mortgage, you agreed to a 30-year term. Every payment you made was calculated to ensure the loan would be fully paid off in exactly 30 years. Your amortization schedule was a precisely calculated path to ownership. But what happened when interest rates rose and your payments increased? For most Australian mortgages, the bank automatically extended your effective loan term. You're not on a path to pay off your loan in the original time frame anymore. You've been quietly reset. Let me explain how this works. When rates rose, you had three options. Option one was to increase your payments to maintain your original payoff timeline. Option two was to keep your payments the same and extend your loan term. Option three was to switch to interest-only payments temporarily. Most Australian banks automatically implemented option two without clearly explaining the implications. Your payments went up because they had to in order to cover the higher interest, but they didn't go up enough to maintain your original principal reduction rate. And here's a concrete example. A borrower who took out a $700,000 loan in 2021 at 2.5% with 30 years remaining, was on track to pay off their mortgage in 2051. After the rate rises, that same borrower making the new minimum payments is now on track to pay off their mortgage in 2059. 8 years have been added to their loan term without them even realizing it. 8 years of additional payments, 8 years of additional interest on a $700,000 loan at current rates. That's approximately $364,000 in extra interest payments over the life of the loan. The banks call this payment flexibility. I call it the 30-year reset trap. And millions of Australians have fallen into it without understanding what happened. The third layer of the trap involves what's happening to your equity, the portion of your home you actually own. For the past 3 decades, Australian homeowners could count on property values rising faster than inflation. Even if you weren't paying off your mortgage quickly, your equity was growing because your property was appreciating. This created a wealth effect that masked many of the problems with high mortgage costs. That dynamic has fundamentally changed. In many parts of Australia, property values have fallen from their 2022 peaks. Not everywhere and not by catastrophic amounts, but meaningful declines of 5 to 15% in many suburbs. At the same time, the rate at which you're paying down principal has collapsed due to high interest rates. This creates a pincer movement on your equity. Your property value is flat or declining, while your debt reduction has slowed to a crawl. The gap between what you own and what you owe is closing from both directions. For borrowers who bought at the peak with small deposits, this has already resulted in negative equity, owing more than the property is worth. But even for borrowers who aren't underwater, equity growth has essentially stopped. I analysed data from CoreLogic and the ABS to understand what's happening to the typical Australian mortgage holder's equity position. In 2021, the median borrower was building equity at approximately $67,000 per year through a combination of price appreciation and principal reduction. In 2024, the median borrower is building equity at approximately $8,000 per year. That's an 88% collapse in equity building. And for many borrowers, even that $8,000 figure is optimistic because it assumes property values stay flat. If your local market has declined, you may be building no equity at all or actually going backwards. This matters because equity is your escape route. Equity is what allows you to refinance to a better rate. Equity is what gives you options if your circumstances change. Equity is what you're supposed to be building for retirement. And for millions of Australians, equity building has ground to a halt. During the pandemic, something remarkable happened to Australian household finances. As spending options disappeared and government stimulus flowed, Australians collectively built up enormous financial buffers. Mortgage offset accounts swelled. Savings rates hit multi-decade highs. Extra payments on mortgages accelerated. The Reserve Bank celebrated this as evidence of household resilience. When rates started rising, officials pointed to these buffers as proof that households could handle higher rates. The implicit message was, don't worry because Australians have saved up plenty of cushion. Here's what's happened since. Those buffers are being systematically consumed every month. The higher mortgage payments drain a little more of the savings that families built up. The RBA's own data shows that aggregate mortgage offset balances have declined by over $4 billion from their peak, and the decline is accelerating. More concerning is the distribution of these buffers. The households with the largest buffers tend to be older borrowers with smaller loans, high incomes, or investment properties. The households with the smallest buffers tend to be younger borrowers with large loans, modest incomes and no backup plan. And I've seen internal bank analysis showing that approximately 28% of mortgage holders now have less than 3 months of expenses in accessible savings. That's not 3 months of mortgage payments, and that's 3 months of total household expenses. One job loss, one medical emergency, one major car repair, and these households are in immediate crisis. The buffer consumption is the fourth layer of the trap. The safety net that was supposed to protect Australian households is being used up month by month to cover mortgage payments. When it's gone, there's nothing left between making your payment and defaulting. The fifth layer of the trap involves income growth, or more precisely, the lack of it. The standard narrative from economists and policymakers is that wage growth will eventually solve the mortgage affordability problem. As incomes rise, mortgage payments become a smaller proportion of household budgets, stress eases, and balance is restored. This narrative is wrong for three critical reasons. First, real wage growth has been negative for most of the past 3 years. Nominal wages have increased by perhaps 3 to 4% annually, but inflation has run at 5 to 7%. In purchasing power terms, most Australians are earning less than they were in 2021, not more. Second, even when nominal wage growth does occur, it doesn't automatically translate to higher disposable income. Tax bracket creep, rising costs for essentials, and the structure of modern compensation mean that a headline 4% pay rise might deliver only 2% in actual take-home pay. Third, and most importantly, wage growth is not evenly distributed. High-income professionals in certain sectors have seen strong salary increases, but the workers most likely to be stretched by their mortgages, teachers, nurses, retail workers, administrative staff, have seen the weakest income growth. Let me give you specific numbers. The median Australian full-time worker earned approximately $65,000 in 2021. Today, they earn approximately $72,000. That's a 10.7% increase over 3 years. In the same period, the median mortgage payment has increased from approximately $2,200 per month to approximately $3,600 per month. That's a 63.6% increase. Income is rising in single digits. Mortgage costs have risen by double digits. The gap is enormous and growing. There is no plausible wage growth scenario where typical Australian workers can grow their way out of this trap through income alone. Beyond the financial mechanics, there's a psychological dimension to the mortgage trap that keeps people stuck even when escape routes exist. The first psychological barrier is sunk cost fallacy. After years of payments, after the stress of purchasing, after making the property your home, the idea of selling feels like admitting defeat. People think about all the stamp duty paid, all the renovation costs, all the emotional investment, and they cannot bring themselves to let go even when holding on is destroying them financially. The second psychological barrier is normalization. When everyone around you is struggling with the same mortgage stress, it starts to feel normal. The anxiety, the constant money pressure, the inability to save or spend on anything beyond necessities, these start to seem like just how life is rather than symptoms of a financial trap. The third psychological barrier is optimism bias. People assume that rates will fall, their income will rise, property values will recover, and somehow things will work out. They keep waiting for the situation to improve rather than taking action to change it. The fourth psychological barrier is complexity aversion. The mortgage system is deliberately complicated. Comparison rates, offset accounts, redraw facilities, break fees, refinancing costs. The complexity overwhelms people and they default to doing nothing because doing something feels too hard. The fifth psychological barrier is shame. Financial difficulty still carries stigma in Australia. People don't talk about their mortgage stress with friends or family. They suffer in silence, unaware that hundreds of thousands of other households are experiencing exactly the same thing. These psychological factors are not accidents. The financial system benefits from your paralysis. Every month you stay trapped paying above market rates because you can't face the complexity of refinancing. The bank profits. Every month you hold on to a property that's destroying your finances because you can't accept the sunk costs the bank profits. Understanding the psychological trap is the first step to breaking free from it. Let me expose another element of the trap that catches many Australians, the rate illusion. You probably know what interest rate you're paying on your mortgage. You might even check it regularly. But here's what most people don't understand. The advertised rate and the effective rate are very different things. Start with comparison rates. These were introduced to help borrowers understand the true cost of loans by including fees. But comparison rates are calculated on a standardized $150,000 loan over 25 years. Almost nobody has a $150,000 loan anymore. On larger loans, the impact of fees is proportionally smaller, making comparison rates misleading. Then consider offset accounts. Banks advertise mortgages with 100% offset as a major feature, but the benefit of an offset account is only as good as the balance you maintain in it. If your offset account balance is being drained to cover living expenses, which is happening to millions of Australians right now, the advertised benefit is worthless. Next, look at honeymoon rates. Many borrowers fixated on a low initial rate without understanding what happens when the honeymoon period ends. Banks offer these rates knowing that a significant percentage of borrowers will end up trapped when they revert to much higher standard variable rates. Then there are the package fees. A $395 annual package fee might seem small against a large mortgage, but it represents additional cost that needs to be factored into your effective rate. Banks have made mortgages so complicated that most borrowers genuinely cannot calculate what they're actually paying. I've worked with borrowers who thought they were paying 6.2%, but when we calculated their effective rate, including all fees and accounting for their actual offset balance, they were paying closer to 6.8%. That difference of 0.6% on a $600,000 loan is $3,600 per year in additional interest. The rate illusion keeps you trapped by making you think you have a better deal than you do. It prevents you from taking action because you don't realize how much you're overpaying. Many Australians believe they have an escape route from the mortgage trap: refinancing. Just switch to a better rate with another lender and the problem is solved. This is the refinancing mirage. The reality is that refinancing has become dramatically harder, and for a significant portion of borrowers, it's now impossible. Start with serviceability assessment. To refinance, you need to prove you can afford the loan at the new lender's assessment rate, typically the actual rate plus 3%. At current rate levels, that means proving you can afford payments at around 9.5%. Many borrowers who qualified under easier conditions in 2020 or 2021 cannot meet this threshold today. Then consider the equity requirements. Most lenders want you to have at least 20% equity to refinance without paying lenders' mortgage insurance. With property values flat or falling and principal reduction crawling along, many borrowers don't have the equity they need. Add in the costs of refinancing, discharge fees, application fees, valuation costs, potential break costs if you're on a fixed rate, and mortgage registration fees. These can easily reach $2,000 to $5,000. For a borrower who might save $3,000 per year with a better rate, it takes 1 to 2 years just to recover the switching costs. Now consider the documentation requirements: pay slips, tax returns, bank statements, expense declarations. Lenders want extensive documentation that many borrowers struggle to provide. Self-employed borrowers, casual workers, and those with complex income situations face particularly high barriers. Finally, there's the time and effort involved. Refinancing is a process that takes weeks or months. For time-poor families already struggling to manage work and home life while dealing with financial stress, finding the bandwidth to navigate a refinancing application feels impossible. The mirage of easy refinancing keeps people from seeking other solutions. They think the escape route is there whenever they need it, so they delay taking action until they discover the exit door is locked. I want you to understand what's really happening at a macro level, because this isn't just about individual households. This is about the largest wealth transfer in Australian history. In 2021, Australian households collectively paid approximately $32 billion in mortgage interest to the banks. In 2024, that figure has risen to approximately $78 billion. That's $46 billion in additional interest payments flowing from households to financial institutions every single year. Let me put that number in perspective. The entire aged care sector costs $36 billion per year. The entire Medicare system costs $32 billion per year. The increase in mortgage interest payments alone exceeds the cost of our entire healthcare system. Where is this money going? It's going to bank profits, which are at record levels. It's going to bank shareholders, including many foreign institutions. It's going to bank executive bonuses and dividends. Meanwhile, what's happening to the households paying these increased costs? They're cutting spending on everything else. Retail sales are falling. Hospitality venues are closing. Discretionary spending is collapsing. The real economy is being starved of spending power because that money is being redirected to mortgage interest. This wealth transfer has profound long-term implications. A generation of Australians who should be building wealth in their peak earning years is instead transferring that wealth to financial institutions. Retirement savings are being sacrificed. Investment in education and skills is being deferred. Family formation is being delayed. The trap isn't just capturing individual households, it's restructuring the entire Australian economy in favour of the financial sector and against working families. Every trap has a beneficiary. Someone designed this system and someone profits from it. Let me show you exactly who benefits from keeping millions of Australians trapped in expensive mortgages. The major banks are the obvious beneficiaries. Commonwealth Bank, Westpac, NAB, and ANZ have reported combined profits exceeding $30 billion this year. A significant portion of these profits comes from the margin between what they pay for funds and what they charge borrowers. When borrowers are trapped and can't refinance to competitive rates, banks can maintain higher margins. Mortgage insurers benefit from the trap. When borrowers can't build equity and remain in high loan-to-value ratio territory, they keep paying mortgage insurance premiums. The major mortgage insurers have seen their premium income increase substantially as property values stagnate. Property investors benefit from the trap. When owner-occupiers can't afford to buy or upgrade, it reduces competition for properties. Cashed-up investors with equity in existing properties can expand their portfolios more easily when household buyers are financially constrained. Wealthy inheritors benefit from the trap. The intergenerational wealth divide in Australia is accelerating. Young Australians without family wealth are trapped in expensive mortgages or locked out of ownership entirely, while those with wealthy parents receive deposits, guarantees, and eventually inheritances that allow them to avoid the trap altogether. Political donors benefit from the trap. The financial services sector is the largest political donor in Australia. Both major parties receive millions from banks, insurance companies, and property developers. Is it any wonder that policies which might threaten bank profits, like genuine refinancing reform or stronger consumer protections, never seem to progress? Understanding who benefits helps you understand why the trap exists and why there's so much resistance to fixing it. Despite everything I've told you, escape routes do exist. Not easy ones, not painless ones, but real paths out of the mortgage trap for those willing to take action. The first escape route is aggressive principal reduction. If you can find any way to make extra payments, even small ones, do it now. Every dollar of extra principal you pay reduces your future interest costs and brings you closer to the equity threshold where refinancing becomes possible. Sell things you don't need, take on extra work, cut expenses ruthlessly, redirect every possible dollar to your mortgage. The second escape route is genuine hardship assistance. If you're truly struggling, contact your lender's hardship team before you miss a payment. Once you miss a payment, your options narrow dramatically. Banks don't want defaults on their books and will often offer temporary relief, reduced payments, interest-only periods, or payment holidays if you ask before you're in crisis. The third escape route is downsizing. This is the option nobody wants to consider, but for some households it's the right answer. If you're in a property you can't afford in an area you don't need to be in, selling and buying something smaller might be the path to financial freedom. Yes, there are transaction costs. Yes, it feels like failure. But living in a home you can actually afford beats slowly drowning in one you can't. The fourth escape route is house hacking. Renting out a room, converting a garage to a rental space, or hosting short-term guests can generate income that goes directly to mortgage reduction. It's not ideal, but it's a lever many households have available that they're not using. The fifth escape route is income restructuring for the self-employed. If you're trapped because your taxable income doesn't reflect your actual earning capacity, work with an accountant to restructure your business in ways that demonstrate serviceability while remaining tax efficient. The sixth escape route is family assistance. If you have family members who can provide a guarantee or temporary funds, this might allow you to access refinancing options that are otherwise closed. Many families don't ask because they're embarrassed or don't want to burden relatives. Sometimes family help is the difference between escaping the trap and remaining stuck for years. Individual escape routes are important, but systemic change is needed to prevent millions of Australians from being trapped in the first place. First, APRR must reform the serviceability buffer for refinancing. A borrower who is current on all payments should be able to refinance to a lower rate without being assessed as if they're taking on new debt. The current rules trap responsible borrowers in expensive loans for no valid prudential reason. Second, the government must ban exit fees and discharge fees. These fees serve no purpose except to discourage switching. They're a pure extraction mechanism that keeps borrowers trapped with their current lender. Third, there must be mandatory rate matching for existing customers. If a bank offers a rate to new customers, existing customers with equivalent risk profiles must be offered the same rate. The loyalty tax that charges trapped customers more than mobile customers should be illegal. Fourth, mortgage documentation must be simplified. The current system of comparison rates, package fees, offset complexities, and fine print is designed to confuse borrowers and prevent informed comparison. A standardized, simple mortgage document would allow genuine competition. Fifth, there must be portable mortgage products. In other countries, borrowers can take their mortgage with them when they move to a new property without starting the application process again. This reduces transaction costs and makes it easier for people to adjust their housing to their circumstances. Sixth, genuine financial education must be provided before people take on mortgages. Most borrowers don't understand how amortization works, what rising rates will do to their payments, or how to evaluate mortgage products. This ignorance benefits lenders and hurts borrowers. These changes won't happen without pressure. Politicians respond to voters, regulators respond to public outcry, banks respond to threatened regulation. The only way to achieve systemic change is for enough Australians to understand the trap and demand action. Your mortgage has become a trap, not because you did anything wrong, but because the system is designed to extract maximum wealth from ordinary Australian families and transfer it to financial institutions and their shareholders. The mathematics of high interest rates mean you're paying more while building less equity. Your loan term has been quietly extended. Your buffers are being consumed. Your income isn't keeping pace. And the psychological barriers to action keep you frozen in place while the trap tightens. But you are not powerless. Understanding the trap is the first step to escaping it. Taking action, any action, starts to break the psychological paralysis, and demanding systemic change can eventually fix a broken system. Here's what I need from you right now. First, subscribe to this channel. I know I've asked before, but I'm asking again because the algorithm suppresses content that challenges powerful interests. Every subscriber helps this message reach more people who need to hear it. Second, share this video with everyone you know who has a mortgage, your friends, your family, your colleagues. They need to understand what's happening to them. Third, leave a comment telling me your story. Are you trapped? Are you escaping? What strategies are working for you? This community can help each other when the institutions won't help us. Fourth, take one action today. Check your effective interest rate, calculate how much principal you're actually paying off each month, call your lender and demand a rate review. Do something, anything, to start moving. The trap only works if you don't see it. Now you see it. What you do next is up to you. I'll see you in the next video. Stay informed, stay strong, and keep fighting.